Have you ever heard the saying, "Don't put all your eggs in one basket"? I wish I'd taken that advice more seriously when I made my first investment. It's a classic for a reason. Too many beginners throw all their money into just one stock, one fund, or even one asset, and when things go sideways, they're left feeling frustrated and defeated. But here's the good news. You don't have to learn this lesson the hard way. Before we get started, let's make sure you get every future episode, Q&A, and real-life investing story. Hit that subscribe button right now and join our global investing community. I want this to be more than just you and me talking. I want us to build a worldwide circle of action takers who learn from each other's journeys. All right, let's get real about diversification. Imagine you saved up $1,000. You hear a friend raving about a hot tech stock, let's call it Alphatech, so you put the whole $1,000 in. If Alphatech's price tanks by 30%, you lose $300. But what if you'd split your money across 10 different companies or funds in different sectors? A drop in one wouldn't sink your whole ship. Diversification is just a fancy word for spreading your risk. It's about making sure that when one part of your portfolio has a bad day, the rest helps pick up the slack. Most of the world's best long-term investors, think Warren Buffett, everyday millionaires, or the people quietly funding their kids' college, are experts at one thing, not betting the farm on one thing. Let me give you a real example. During the COVID-19 market crash in 2020, U.S. airlines lost over 60% in value. But investors with money also in healthcare, tech, and bonds actually saw their portfolios recover within a year. Some even grew. The safest path wasn't a lucky pick, it was having a mix. Nowadays, you don't have to be wealthy to do this. With ETFs and index funds, you can diversify globally even with small amounts. Want global stocks? There are ETFs for that. Want real estate, gold, or bonds? One tap, and you've added a new layer of safety to your investments. Let's walk through a practical beginner's portfolio, no matter where you're starting from. Suppose you have $100, 8,000, or 90 euros each month to invest. Here's how you might split it. 50% in a broad market ETF or index fund like S&P 500, Sensex, or MSCI World. 20% in a bond fund for stability. 15% in international funds or emerging markets for growth opportunities abroad. 10% in real estate investment trusts REITs, so you tap into property, even with a tiny investment. 5% in gold, commodities, or something alternative as a hedge when markets get rough. You can use local apps or international brokerages for this, and some even automate the balancing for you. Try searching for Robo-Advisors or target date funds in your country. They handle most of the work and keep things balanced as you invest more. Listen, your numbers don't have to be the same as mine. The point is to cover a few key areas, so you don't end up with all your hopes riding on one debt. If markets drop, and eventually they will, it's the mix that lets you sleep better at night. Here's something else I wish I'd known sooner. Diversification isn't a set and forget thing. As you grow, maybe you get a new job, move countries, have kids, or just see your portfolio rising. Pause once or twice a year and check, does my mix still fit my goals and my risk comfort? Adjust as needed, and don't be afraid. Everyone's journey has twists and turns. Let me share a quick story. A friend of mine in Singapore started off putting everything in high-growth Asian tech stocks. For 2 years, things were amazing, until a market correction cost him 30% in weeks. After diversifying into global ETFs, bonds, and a bit of real estate, the next drop didn't faze him. He could ride it out with confidence, knowing he was prepared. So before we wrap up, here's your action plan. List every investment you have, no matter the size. Divide them by type: stocks, funds, bonds, real estate, commodities. If you see your lopsided door all in one company, sector, or country, start shifting little by little toward a more even mix. If you're using a Robo-Advisor or pre-built fund, double-check that it's automatically rebalancing for you. If you have questions about building your diversified starter portfolio, drop them in the comments. No judgment, just real help. If you made a rookie mistake putting all your eggs in one basket, share your story. Someone else could learn from it right now. Don't forget to subscribe so you won't miss the next episode, where we talk about emotions and investing, how to navigate fear, greed, and news headlines and actually stick to your plan. Remember, every investor's path is different, And it's not about being perfect. What matters is showing up with discipline and consistency, taking smart steps, and learning along the way. Your financial future is built one good decision at a time. See you in episode 6 and keep moving forward, no matter where you start.